Hello, everyone. I'm Gayatri from Index One, and I'm joined today by Jordan Kimmel from Magnet Investing Insights to discuss how trust related metrics can help evaluate public companies. The trustworthiness of companies can be assessed using quantifiable metrics and publicly available data. One approach is Trust Across America's FACT framework, which evaluates companies across five key areas: financial stability, accounting conservativeness, corporate governance, transparency, and sustainability. Using these metrics, it becomes possible to screen public companies through a structured, rules based process. This framework forms the foundation of the Trust 200 index, which is calculated by us at Index One. At Index One, we work with a wide range of ESG and thematic indices, and the Trust 200 index represents a distinct and trust based approach, and we'll be exploring that further during this webinar. Today, we're pleased to feature Jordan Kimmel, the creator of the Trust 200 Index, which seeks to track the performance of the top 200 US equities according to the FACTS methodology. Jordan, welcome. Thank you for joining us. Can you tell us more about the index and what motivated you to create it?
Sure. And first of all, it's a pleasure to be here with you. And this is something I'm very passionate about. So let me just kind of jump right into this. And you could tell by just seeing me, I've been in the industry for a while. I had actually developed a previous model which looked for the fastest growing companies, the companies with the highest return. Well, about 15 or more years ago, it was really around the financial crisis where it became very clear that there was a breakdown in trust, there was a breakdown on Wall Street, and people were saying, look, I just don't trust the market. I don't want to be involved in the market. And I said, this issue, this problem is something that really can help me, help the public go forward. So what we did, is rather than look for value, growth, and momentum, which was the key of Magnet back then, what we did is we took the same approach that I did very early in my career, literally 40 years ago, where we went to the experts in the consulting fields of management and accounting, and we said, we want to define what trustworthy is in a company. Can you help us look at some indicators and how can we measure this? And then how can we ultimately put them in order? And the feedback was incredibly funny. They said, you can't do this. It doesn't work. What happens is we met with the different data sources that popped up literally after WorldCom and Enron back in the very beginning of the turn of the century. What happened was there was outrageous, egregious issues that popped up with the way these companies were run. Wall Street was touting them and promoting them, issuing shares and stocks and bonds. And it turns out other companies showed up saying, hey, listen, we could measure the independence of a board. We can measure accounting conservativeness. We can measure sustainability of operations and transparency. But the issue was they all were in separate silos. So I met them and said, listen, I've in the past blended value, growth, and momentum, all quantitative measurements. I was told it was a dumb idea back then. You should pick one. You should be a growth investor, a value investor. What are you doing? You're wacky, right? Turns out, as we know, Magnet had incredible performance, was licensed out. And I said, we can do the exact same thing again. And what they said was, you can't do this because we have different SIC codes. We have different reporting issues. I said, don't worry about it. I'm not smart enough to do this, but I have a team. And I have a team of some of the most brilliant data specialists. And my original co-creator with Magnet was a leader in chaos theory. I said, let me put my team together on this. And it took a few years to develop it, frankly. We were willing to do it. But here's really the kicker, which is really funny. People were saying the reason you should use my accounting data is our accounting data helps you to outperform the market. And I said, I'm not interested in that. I'm interested in trustworthy companies. And then we met with the governance people, and they said, we can actually show you independent boards and all kinds of consistencies of management. And if you do that, it will help you to outperform the market. I said, I'm not interested in outperforming the market. I have Magnet, which is what does that. And then I went to another meeting, and they said, with your background, are you telling me that you're not planning on creating a financial product? And I said, I'm not. We want to bring trust back into the market. That was our goal. Another meeting came up, same kind of conversation. I looked around the room and I said, we're going to start a financial product, not to have the highest return, G, but because our goal was to bring investors back into the marketplace who said, I don't trust Wall Street. I don't trust big public companies. I don't trust management. I'm going to sit in a money market at 0% or 1%. I'll buy bonds at 2%. I just don't trust the market. And we said, rather than have the highest return with Magnet, maybe the crowning achievement of my career will be to help bring back trust into the marketplace. And that was how it started and really why it started.
Thanks, Jordan. That's really interesting. Love the backstory. And just before we went live, we were talking about, is this an ESG index? I know you said it's not really an ESG index. So tell us more about that, and how would you say this index differs from incumbents, if any?
Yeah, no, it's such a great question, because when we started to describe what we were trying to do, people would say, is this ESG? Or, you know, and ESG really was a buzzword that came around big time about 2 years after the model was created. There were always folks that focused on quality, but this concept of ESG, which I think is really a great concept, the problem is it's really hard to measure certain things in sustainability. And then what we found really troubling is a lot of companies were actually working with consultants, learning how to fill out questionnaires, learning how to game the system, and prescribing to all kinds of, say, things that were voted on, things that were gamed. And I'm a data guy. And so what I said is, you know, the focus here has got to be on fundamentally sound companies. But the issue that a company is going to measure themselves on the output of gas emissions or garbage output doesn't apply to financials, doesn't apply to a lot of other industries. So the thing is, what the ESG concept really resides underneath facts, if you will, because what we said with facts is you have to respect your customers, you have to respect your community, you have to respect your shareholders. All these things were all brought into effect. And you know what we find, Chief? Really interesting. Companies and management teams that have certain priorities and certain way of acting and certain methodologies of transparency, well, what happens is other issues that came up just within the last few years, things like how many women are on the board. We didn't look at that in the beginning. It wasn't something that came up in the beginning. But you know what we found? We found that the companies that ranked up highest on Magnet and highest on facts actually already had women on board. And they weren't bringing women on board to show that they had women on board. And it's a way of acting. So the thing is, I'm not knocking ESG. What I would tell you, part of my study is to see what other funds are doing or what other ESG funds are doing. And when we ran those holdings through our model, we were incredibly disappointed to see what was in those funds. Things like animal testing, things like, things that did not belong in a quality ESG type of thing. And the question was, why were you in those companies? And the portfolio managers would say, because they're going up. And that just doesn't resonate with us. So I see what you've done is bringing this slide, which is a really cool slide. I want to go over maybe just a little bit of the methodology. And what's really important to me is, just from my career as a kid, my whole life, my whole investing career was all about quantitative numbers, not my feelings about how good a company was, but did a company have this? Did a company have that? And what we found was, when you start with the 1,000 largest companies, only 400 of them, roughly, had all the complete data we were looking for. And why is that? Well, companies are asked to fill out forms and questionnaires, and smaller companies didn't have the manpower. They just didn't. They were like, they got questionnaire fatigue, and we were looking at, well, this data is missing and this data is missing, but we have a very careful machining approach to keep eliminating and screening down. And so one thing that happened, Jay, was a consultant said to us when we created the index, you should have 200 companies. I think that honestly was a mistake. I think it was bad advice. I haven't seen any other index with 200 companies. But so when we try to manage money for clients, we kept screening it down and filtering it down and machining it down to where we were actually able to run separately managed accounts with, say, 25 companies, all of them ranked high on Magnet, after all fulfilling the facts initial screen. So the whole idea is, we couldn't see some sort of hot new company that everyone was talking about, just put it in. It had to actually have the data. It had to have years of seasoning and so on. So we really believe that the facts reduces risk, and the Magnet helps drive a little alpha, and the proof has been in the pudding.
Love that. Thanks, Jordan. So speaking of methodology, let's look at it. Could you go through, I know you've touched on it a bit, but could you go through the stock selection process, the weighting approach, rebalancing schedule, and any other key elements that you want to discuss?
Sure. Great. So the whole idea is, in terms of the rebalancing, what's kind of interesting is, I've managed money for people for years. I've also consulted to other corporations that wanted to use facts. And what they were saying to me is that when we were doing quarterly rebalancing for managing money, that the turnover was too high. And some of these firms were very tax sensitive. And then what we did is we said, let's actually see what would happen if we literally only rebalanced once a year. And what we see is that the returns are good. Frankly, if you're managing money, have experiencing it, the higher the turnover might actually increase the performance. But we're not looking to have the highest performance. We're simply saying, if somebody could get invested in the market and not be in the money market and not be in the bond market, but they could trust companies, even if they did less than the market does, it would be better than being in the bond market. What happens is that we also, in the very beginning, we asked the question, what should we weight heavily, or what should we weight a little bit lighter? And I knew what we were doing in Magnet, where we weight different things different ways. But what we started at the beginning was saying, let's take the 5 drivers of trust and weight them all equally. And that's how we started. We have not changed that. What we've seen in our own work is perhaps some of the factors should be weighted higher. And when I manage money, I weight them a little bit differently. But in the index itself, everything is simply equally weighted. And people have always talked to me about how I could enhance. And in this case, we're not looking to enhance anything. We're saying, let's identify the most trustworthy companies. If I was to start this process again, we probably would only do 100 companies. We kind of laughed that we went down to the last 200, the name. They're not companies I would have in my portfolio, but people buy the S&P, and there's hundreds of companies in the S&P we wouldn't go near either. So this is just plain vanilla. There's no options. There's nothing tricky. There's nothing special. And as you know, because we've relied on Index One and the power of your technology, everything is equally weighted. We do know if you have the highest ranked stocks and you weight them a little stronger, you might enhance your return. We're not doing that. We're saying equally weighted, each stock is simply 0.5 of 1%. And, the other thing that we said is that when people say, well, what do you benchmark against? What's the proper benchmark? The real proper benchmark for this index is really the Russell 1000 value, but everyone benchmarks against the S&P. So we said we're probably not going to beat the S&P. The back test said we were a little bit ahead of the S&P, and we crushed the Russell 1000 value. Well, guess what? It's exactly what happened. And I asked, how many diversified indexes are out there that have beaten the S&P for the last 14 years? And the answer is, I think there's one, and it's the Trust 200 index. That's all there is. We're super proud of it.
Of course, and thank you for that. I know you talked about the benchmarks a bit, but we do have a fact sheet here, and obviously just for our audience, as always, please note that any back-tested performance shown is hypothetical and for illustrative purposes only, and past performance is not indicative of future results. Jordan, you talked about why you chose the benchmark, but let's go through the returns and key metrics and the historical performance. What do you make of it?
Well, you know what? You might not love this answer, but I'm going to answer it anyway. I don't believe in the Greek as much as the consultants do. And what happens is people even said to me, is facts real? Is it going to work? And I've said, we're not going to really know it works until 3 or 4 business cycles. We're talking 10, 15, 20 years for real people to say that the data is true. Well, the issue is that over the last 10 years, and I'm not making any complaints because our results are great, the markets have been so wacky. And we've seen things where following the financial crisis, companies that got a 0 for us, a 0 in corporate governance, suddenly ranked out as 100 on other people's models. And we said, well, how can that be? And they said, well, these companies came under supervision. So when they're under supervision, that's like being in detention. And so and I'm not going to name names on them, but companies which were the crux of discussions of pesticides hired consultants. Suddenly they ranked up really, really high on sustainability, sold their company for billions of dollars, and left the buyer on the hook for billions of dollars of lawsuits, right? And I'm not going to mention any names, but these are high-profile examples. So I'll just tell you a real quick, funny story. My director of research, who helped me build Magnet, studied Magnet at a certain time in the 1990s. And he said, Jordan, it works great on large cap. It works great on small cap. And it doesn't work at all on mid cap. I said, what are you talking about? You know? And so 5 years later, he comes back to me and says, now we're testing the data again, and we see it works best on mid cap and not so much on large cap. And I said, come on, man, you just believe you're Greek way too much. The fact is, here's what I'm going to make an assumption to you, G, and this is what the whole model, this is what William O'Neill from Investors Daily told me about Magnet. He said, you're making a certain hypothesis. This is not a back-tested model. The hypothesis was the following. Companies that had better and more stable financials, more conservative accounting, corporate governance that was well-respected and diversified with a diversified board, independent board that had transparency of operations and also ranked up on sustainability measures, those companies would probably be better than the whole universe of companies. And to me, it's purely obvious. But people say, well, I'm going to wait. I'll wait. What I want to mention here is really something that is something I don't want to lose the time and not mention. So originally, one of the great trillion-dollar companies licensed Magnet. We went to another group, billion, one of the largest creators of UITs and ETFs. And we went in with a very prominent money manager with both of our names on this. They back tested it. They looked at it. They ended up writing the prospectus, and we went live. When we went live, they said, trust is such a strange thing to talk about. We cannot come up with an elevator pitch. There's no elevator pitch for this. So you know what? We're going to discontinue the product. I was like, what? You spent all the time on prospectus and backtest and this and that and legal stuff. And they said, we just don't have an elevator pitch. It's a complex subject. And I said, people don't invest their money in an elevator pitch. People invest their money in thought out strategies. Guess what? I was wrong. People just need something simple. And that's why we're trying to make this as simple as possible. But we've met with and they went live. We were very, very excited. And when you look at the results, obviously, the company wishes they went live and stayed live for 10 years. But you know what? The second best time to plant a tree is today. So what could I say?
That's right. Well, yeah, that's pretty much, I think, the whole thesis to your index as well, because it's been running for so long. But yeah, amazing. Thank you so much for that. Cool. Brilliant. And also, I just wanted to quickly mention that we did include this in the slides. Do you want to quickly talk about them?
Yes. So this is not really our subject. I would like to talk maybe about index one for a minute, but let me just say my first book came out when people were receiving data by fax, right? And what we said is we could actually go into the internet and pull out data, and we showed Magnet investing. I was super proud of that. It led to some licensings and so on. The second book, The Magnet Method of Investing, and this is really important. This was done in 2009-ish. And what we were trying to figure out is what's the right size for a portfolio, not for an index, but for portfolio. And really what it comes down to is once you're past 25 names, the benefits of diversification and really managing money kind of disappear. And this is why when we're running money, people say, I want to be invested in facts. I want to be invested in the trustworthy companies. How do we actually invest in the index? And we say you can't invest in the index. There's currently no institution that's licensed the index and so on. What we feel is there's a huge opportunity right now with focus on American companies with foreign investing into America. Sure, they could buy the S&P, but there's 300 or more companies I wouldn't go near in the S&P. So potentially, Facts makes a beautiful UCIT product, and clearly there's more aggressive investors that say, I don't even want 100. Give me the top, take the top fact stocks and then run magnet on it. And let's get down to 25 stocks and try to make a little bit more money. So, we do that for individuals. But the real focus, I don't want to lose it, is if we could actually, what we thought, I want to bring up one more point. It's what we learned on this process. We thought companies that ranked up highest on facts would like to promote that fact. But what it is that when you hold your hand up and say, I'm trustworthy, people run away from you. They don't want to be associated by calling themselves trustworthy, right? They'd rather just be in the background and do it, right? And so this is something that we learned. Our initial goal, and all the TV I've done in the past, we were going to bring on companies on TV and show why they rank that high, and maybe they'd make them the beacon for other people to emulate what they do, because they'll get more capital. And we said by showing off who's the best operators, the most transparent, the best boards, the most transparency, we thought, and still do, think that can make an impact on corporate behavior. But what we also know is that what the media loves is to catch someone with their hand in the cookie jar. We find someone who's done something wrong, a fire that broke out, a CEO that broke down and busted his trust. That's what people want to talk about. And we're saying, we're holding true, saying, let's continue to operate with the most trustworthy companies, show they outperform, try to show why they do. And like I've said, we're incredibly proud. When we met you originally, we met Index One. What we've been able to do is to virtually hand off our screen picks and have you do the hard work behind the scenes, which we really appreciate. And what's really cool, what I think is a special feature of your site, not only does it show the performance, but it shows the top 10 stocks at every point, which are currently leading the index. And they might just be idea generators for people that say, I don't want to pay Jordan. I don't want to invest with Jordan. I just want to get the fruits of his work. And they can go to your site and look at the top 10 stocks at all times. And what we know is those companies aren't stories. Those companies are delivering. So it's a really cool thing. I encourage people to go to your site, not only maybe with our index, but your other index, and see what's ranking up the highest, because you want to be involved in companies that are executing properly.
Absolutely. And thank you for your words. So yeah, just really quickly at Index One, we offer a holistic index calculation platform, and we aim to deliver fast, flexible, and scalable indexing solutions. And we help build indices based on fully custom strategies like this one, with tools for backtesting, index calculation, rebalancing, corporate action processing, reporting, and distribution. So the Trust 200 index was established on our platform using a CSV file containing the strategy's weights and constituents, and the index is rebalanced on an annual basis through our automated rebalancing corporate action tools. And so from back testing to calculation, maintenance, distribution, and reporting, the full life cycle runs seamlessly on our indexing platform. And I was just going to ask you about your experience, but you've already mentioned it. So thank you so much for saying that. And we've known each other for years now. And I know we have, actually, it might be worth even mentioning that you do have an ESG version of the Trust 200 index that we're
Correct.
calculating for you. Do you want to quickly talk about that as well?
Sure, sure. Well, being that we got very familiar with the crowd in ESG, part of the secret of investing is knowing what other people look for. And so we know that there's additional screens that people will say, look, I don't really care how well Exxon runs their business. We don't want to be in oil and gas. We don't want to be in certain mining companies that destroy the planet. I'm not saying whether I agree or disagree with that. What we know is that someone's got to mine for certain products like copper. Someone's got to produce oil to run cars and refrigerators and whatever. And so the companies that actually do the best in their own world, but so what we do in the regular model, we do not exclude anybody. We do not weight sectors the way S&P weights, and we let it free flow a little bit. The only thing we do is we put a cap on how much can go in any index. But in the index of ESG, it's kind of like saying when someone is gluten intolerant and you're going to give them gluten anyway, that's not a really good thing to do. What we say is, if you'd like to have certain things excluded, we will exclude them on your behalf. We don't want to be the boss of anyone else's money, and we don't want anyone to lose the opportunity to work with facts because they have a couple extra criteria. So we know what they are. The ESG is actually the facts model, the facts constituents, with several companies that have been excluded because we know they wouldn't sit right with an ESG crowd. And let me just mention one other thing, G, and we've been doing this now for 14 years, live money. We're obviously not good at marketing. We're good at results. We're not good at marketing. So I'm going to just mention, if any institution or any RIA has a better idea how we can maybe either take the index from 200 to 100, or how we can help your clients. The main thing is that what you should never hear again is, I won't invest in the stock market because I don't trust the companies. I don't trust the management, and I'd rather just stay away. That is a shame because I have believed as a kid the stock market is the greatest wealth producing machine there is in the world if you know how to harness it. So to say, look what these guys did at WorldCom, look at what they did, and they massaged the numbers. And we're finding, by the way, G, some very, very popular companies that rank up unacceptably on our accounting measures. And we're not going public to show who they are, but they're not in our portfolio. And since we've been managing money, running money, there has not been a single incident on one of our constituent companies that made the front page and embarrassed us. And that's something we feel really good about. And so if you screen carefully enough and you eliminate the bottom feeders in all the categories of FACTS, and none of them are allowed in your portfolio, what you'll find is a fairly good return. We had no idea or expectation that we'd really be ahead of the S&P for 14 years. We are. And then when you break down those 200 to a more bite-sizable group in a portfolio, I believe you could do even better.
Thank you, Jordan. And of course, we're proud to support Trust Across America and Magnet Investing Insights by enabling the backtesting, calculation, and distribution channel for this index. So, yeah, thank you for placing your trust in us. We're very proud to be calculating this index for you. Cool. We'll now open the floor for Q&As. So to our audience, please feel free to submit the questions in the chat box. We have actually received a comment from our very consistent viewer, Badami. Thank you so much for your comment. This is a very interesting idea, excellent discussion. Thank you, Mr. Kimmel, and all the best and great work as always to the Index One team. Thank you so much. Amazing. So I guess in the meantime, my question to you would be, how many constituents in the index actually score highly on the facts framework?
Right. So this is a question that I really love, and here's why. Everyone, every single company in our model has achieved a benchmark above what we look for in each category. And the reason I bring that up, and the reason I think that's so important, is I see and I read the prospectus on whether it's mutual funds or ETFs, and they include a sentence that say 50% or 60% of the constituents in our portfolio match up to our criteria. And I'm going, what? How'd the other ones get in? And they got in because they were going up and people were chasing relative strength. So this is not a relative strength exercise. We're not looking for the fastest growing, highest flyers, highest beta companies. What we're saying is we'd rather eliminate all those, and every single company, we have distinct and isolated data from different sources, which shows what the FACTS scores are on each one. And I'll tell you why that's another interesting point, why this has been so challenging over the years. A lot of the data companies that we subscribe to were all being acquired in a Pac-Man methodology by whether it's ISS or Sustainalytics, and these independent, wonderful companies that we were subscribing to their data kind of got absorbed, and some of their data is no longer available. So we went ahead and created with our data people what we look for. So a lot of it is now created by our internal team, but following the exact methodology of what we started with. And where things have changed, if I could just give one idea, some consultants said to us, well, when you have these companies with A and B shares, the B shares are controlled by management and they could do whatever they want. Those companies are not trustworthy. You should stay away from them. So for the first 5 years, we screened out Google, Facebook, and then we looked around and said, why are we handcuffing ourselves? A and B shares are really not what we thought about in the beginning. And but it's super important for us that you find a symbol, a public stock that's in our portfolio where you say, Jordan, how the heck did this get in? They've had problems with the environment. They've had problems with the SEC. How are you allowing this to be in there when and we say, every single company has the integrity that we would give them my house keys and my Social Security and go away for the week. That's how we feel of the companies in the portfolio.
Thanks, Jordan. And we've got another question from Badami. Good day, Mr. Kimmel. I hope this is an appropriate question to ask, but how does your business model work? You have the Trust 200 index and it's licensed out to fund managers to benchmark their performance. Was curious in that case on how the Russell 1000 is your benchmark.
Okay, so good question. Thanks for the question. So in terms of the business model itself, the license, just to be really super clear, Trust Across America is not my entity, right? And we license out non-exclusively to manage money from Trust Across America, which I won't hide was created by my wonderful wife, Barbara Kimmel. That's her entity. And she has been in the business licensed out to other managers. And the whole idea of Trust Across America and then ultimately Facts, the way I work with it, was not about trying to how much money we can make under management and so on. I think that the whole key is that my income, my business has been around managing money for individuals and smaller institutions. And so, yeah, I think that to answer the question specifically about the Russell 1000, why I think that's the right index is because that's the universe that we actually start with. And so there's lots of companies that are not in the S&P quite yet. A lot of them are. And then I also call this value with values, because one of the last steps that we're doing is we are actually screening out through the magnet methodology super high price to sales companies. We are screening out companies without what we think is outrageous valuation, even if they rank up high. Because when you're screening down, one of the really interesting points here is that not only have we outperformed, but I think we've outperformed with significantly less risk. And the reason I say that is because our sample companies have lower PE than the S&P, lower price of sales than the S&P, higher dividends than the S&P, higher profit margins than the S&P. So this is value with values, and it's unique along the way. So we were screening out a lot of the companies that are household names that we believe are subject to real price corrections when the water goes out, when the tide goes out. So it's a value approach with companies that understand the value of business and their reputation.
Amazing. Thank you, Jordan. And I hope that answered your question, Padami. Thank you for asking your questions. Amazing. I think we're a little bit over time, but I think we had such a lovely conversation. So thank you so much for taking the time and speaking with me today, Jordan. And to everyone that joined the webinar today, thank you so much for joining. And be sure to subscribe to our newsletter for updates on future content. We appreciate your time and look forward to seeing you all again. Thank
Really
you.
been my pleasure. And reach out to questions through through magnetinvestinginsights.com. We're happy to go over it. And I know sometimes I don't go from A to B quickly enough. Thanks for allowing me to take the time and as much as we did. And we'll do it again soon, okay?
Of course. Yes, definitely.
Thank you.
Thank you,
Thanks for your
Jordan.
time.